as you probably know, the tariff situation is still outstanding. It's not resolved yet. There is no agreement made yet. And even though everything's green and everything's happy, we are still open, right? We're kind of vulnerable to more uncertainty and corrections. Here's what I have to say. During uncertainty and crazy fundamental events and, of course, crashes, the masses are the first to worry, and they are so loud. But I think it's pointless. And I'm going to share something very, very macro with you, as in like, not macroeconomics, but like meta. Meta, like really looking outside the box, okay? If you just understand and think of very important ways the world works, like, let me make a little text here. Okay, so these things, okay? Inflation, currency debasement, which again, we're going to talk about today in the future topic. Debt to GDP ratios worldwide. What this means is a lot of countries are in debt. Most are in debt. And then when you compare that to how productive they are every year, how much money they make every year, that's what I'm talking about. And then you got social programs. So like retirement and pensions, okay? Government institutions with huge chunks of social programs relying on the growth of the markets. So your pension funds, your retirement funds, that which you rely on from the government when you retire. How does the government make that money? Well, yes, they tax you. They tax employees and workers to get those funds to pay you out when you retire, but they also take those funds and they put it in the market. Yes, they put it in the market so those funds can grow. Okay, so that's what I mean when I say social programs. I should put government, retirement. And this is very key. Might be the most key. The wealthy having their money in the market to grow wealth and hedge against inflation. So, these pointers here, these 5, not limited to these 5, but these 5, these factors practically guarantees that the markets will always recover and continue to make new highs over a long time horizon. I should write that because that's a really good soundbite. These factors practically guarantee that the markets will always recover and continue to make new highs over a long time horizon. So, if you've gotten in snipers, this is what I talk about in chapter 3. It's either 2 or 3 when I talk about the market. I should actually take this and paste it right here on S&P. This is where it belongs. The market will always recover and continue to make new highs over a long time horizon. Let's go on the yearly chart. Here's the yearly chart from the S&P's inception in 1871. 1871. That's a long time. Let me calculate exactly how long. 2025 minus 1871. 154 years ago. Remember what I said. No matter how bad it gets, the markets will always recover and continue to make new highs over time. There were many bad... Oh, let's go to 1920. Everyone knows about 1920s. Look at that. 1929. Black Monday. Okay, the worst crash. Will always recover and continue to make new highs. That is just the way of the market. it is practically a guarantee that it will, this chart right here, S&P index, will always recover, no matter how big or bad the crash, and will always make new highs over time. Why? Once again, because of these things. Because of inflation, because of currency debasement, because of debt to GDP ratios worldwide, which makes countries and central banks print money, which causes asset prices to soar. Social programs. The government invests your money that they tax you into markets, so the markets have to recover. And the wealthy having their money in the market to hedge against inflation. These 5 factors practically guaranteed the markets will always recover and continue to make new highs over a long time horizon. In 254 years, that has not been proven wrong. 254 years. So if another crash happens, whether it's during our cohort, whether it's in 2025, or it can be any time in the future of your investing journey, just remember, it always gets super shitty before it gets really good. Always. Every single time. It always gets shitty before it gets good. So, for as long as the wealthy and rich obtain their wealth and maintain their wealth through the financial markets over 250 years, things are going to be okay, and they're going to continue to recover over time, no matter how, doesn't matter how big and bad and deep the crash is. Just follow what the wealthy and successful are doing, not what the poor and uneducated are doing. You don't want to freak out, because the poor and uneducated, the ones freaking out, they just keep getting poorer in the market. If they're in the market, they keep getting poorer and poorer. So you don't want to follow what they're doing. Follow what the rich and wealthy and successful are doing. So, pop quiz. We've spoken about this before. Talking about crashes and stuff. What is a price candle? Like, if you could simplify it, what is a price candle really? Type it in the chat. What is a price candle? What is it a display or a representation of? Yep, I like what Clint and Jenna have said. Clint says, a reflection of what people think something is worth. Yes. Right, I love what you said there, because it's not what something is actually worth. It's what people think something is worth. That's very key. Janet says, indicates the price spread that people were willing to buy and sell an asset for. Sure, yep, pretty much what Clint said. Okay, let me share my summary. Price candles are just a display of human emotions. Human emotions. So, what people think something is worth, it's down to their emotions. What people are willing to buy or sell an asset for, down to their emotions. Fear or greed, that's really it. Every single price candle you see, whether it's the daily chart, weekly, monthly, yearly, 1 hour, every single price candle is a display of human emotions. So you probably heard in my courses, even my content, the emails I send, posts I make, the financial market is really just the collective market mind of human beings. It is a display of human emotions. That's it. Price candles display the collective fear or greed of humans. And so as fear and uncertainty increase, like in these parts, that impacts the stock market and crypto market. Why is that? It's because stocks and crypto are risk assets. They're not the only risk assets, but for example, stocks and crypto are risk assets. So in times of uncertainty and fear, what do people do? They pull money out of the stock market because they perceive it as risky. They perceive it as not safe. It's not a safe place to have your capital because it's too risky. You're going to lose value. It's going to drop in value. You don't want to lose your money. And then you got the really serious investors, right? The wealthy, hedge funds, institutions. What they do is they move their capital onto safer asset classes. Bonds, treasury bonds, are one of the safer asset classes. Now, I'm sharing this to pull this back into our first two cohort calls with the US and their debt. Let's go back to my notes here. Wow, okay, let's spread that out more. Okay, so remember this. When things are risky and asset prices are falling because there's some fundamental event going on, people pull their money out of risk assets like S&P, stocks, and crypto. Now, the side effect and kicker of that is as people pull money out of the stock market, this chart here, stock market, oh my goodness. As people pull their money out and prices fall, and as they take that money and put it into treasury bonds, which is seen as a safer place to put your money, it's a traditionally safer asset class. What that ends up doing is it sends bond yields down. Bond yields is just interest. Okay, so if you put your money in bonds, you're going to get interest back from holding bonds, and that's what we call bond yields. So if bond yields go down, this lowers interest rates, which is going to come in handy when someone has to refinance the $9 trillion of government debt this year. And so I bring this up to be like, is it a coincidence? Is it a coincidence that what happened when it did? Hey, make people fear, make people doubt, make them uncertain, make them panic, sell off risky assets, put it into safer assets such as treasury bonds. And when too much money floods into treasury bonds, the interest rates of those bonds go down. And if interest rates go down, then when it comes time to refinance a huge debt, then, hey, the interest rate on that debt is going to be lower. So I bring that up once again. Is it a coincidence or is it a master plan that someone thought of here that no one was really seeing? So we'll see what happens with interest rates. But yeah, we know that Trump is trying to influence Jerome Powell to lower interest rates. And I'm thinking to achieve this, to get lower interest rates, to make this cheaper when it has to be refinanced, something has to make the market look weak, which is pretty much what we got, right? We got the trade war, we got the tariffs. It caused a lot of uncertainty which caused a lot of fear displayed on the charts. Panic and fear. Remember, all these are is a display of human emotions. And in this section, it was fear.